should you buy a home in this super crazy expensive market? Well, that's a question only you can answer for yourself. But I want to give you some information to consider if you're thinking about buying a home, and just kind of look and see what would the short and long-term impacts be of continuing to rent, assuming you're renting, or what if you went ahead and bought a home at, what some feel like are inflated prices. So let me show you this analysis. I want to share my screen with you, and hopefully you can see this table. You can see on the far left column here is rent. So this is assuming you're renting now. You're paying $1,200 a month. As we go through this analysis, you'll see also that this is assuming your rent stays the same for the foreseeable future, or for the future, the entire future of this analysis, that your rent doesn't go up. And we know that's unlikely, just because rents, like everything, has been trending upward lately. This is also not taking into consideration any other costs that might be associated with renting, like rental insurance. We're just looking at your rent today, and we're assuming $1,200 a month. So the first question is, if I want to keep my payment around $1,200 the same, or maybe I'm willing to go up a couple $100, how much of a home can I buy for that much a month? Well, here's some purchase price scenarios that might give you some reference points. So I did $180,000 purchase all the way up to $225,000. These are all in $15,000 increments. These are all 30-year fixed rate loans. They're all conventional loans with a 3% down payment. This is based on a 740 credit score, and this is based on the rates on the day I built this scenario. So you can see there, you got your purchase prices. The second line down is your down payment. Again, this is 3% down payment. Now, I want to direct your attention down here as well to your cash to close, because you may know when you buy a home, you've got to have your down payment, but then you've got some closing costs and some other stuff you have to have, like your homeowner's insurance and prorated property taxes and stuff like that. So this cash to close line is just showing you, if you bought a home with a 3% down payment and you were covering all the costs and not getting any assistance through a down payment assistance program or from the seller, either one of those can be an option in some cases. But if you were covering everything yourself, this shows you about how much cash you might need. Okay, and that's including the down payment. So let's go down here to the total payment line, and this just shows you what your payments might look like at these different price points. So you can see you can keep your payment around $1,200 all the way up to a $195 purchase. It goes up a little bit from there as you go over the $200,000 mark. One other thing I would note here is these figures are not based on any particular property. And as far as the property tax and the homeowner's insurance, I'm just estimating on that. So, if you were to buy a property that had a lower property tax, let's say outside the city limits, maybe it didn't have city taxes, that might give you a little bit more buying power as far as your purchase price goes. But these are estimates. They're good estimates, but they are just estimates. This next line down here shows you your principal paid. So, every month when you make your mortgage payment, part of that money is going to pay down the principal of the loan, thereby building equity for you in this property. And as you can see there with the rent, none of the money is building any equity for you. It's all going toward the landlord. The next line down is the net monthly payment. So this is just showing you the difference between your total payment, subtracting out the principal paid, and it's giving you the net monthly payment. So the system is calculating that as saying, hey, part of the money you're paying every month, the $1,154, is going to amortize the loan and is going back to you in the form of equity. Therefore, the rest of this is what you're actually out. You're out of pocket that amount because it's not building any equity for you. And then your net monthly savings is the difference between what you're paying right now in rent and the net monthly payment. Let me show you a few graphs here. This first one is the graph that shows you the difference in the net monthly payments. Again, this is the difference between what you're currently paying now in rent. All of that money is leaving you. It's going to the landlord. Whereas these other net payments, that's the amount that's actually leaving you, because remember, part of your mortgage payment is paying down your loan balance, thereby building equity in this home for you. These next two graphs are where it gets really interesting. So let's look at this one, rent versus principal paid in 60 months. So again, 60 months is 5 years. Over the next 5 years, if you're paying $1,200 a month, and this is assuming your rent doesn't go up any, you will have paid $72,000 to your landlord. That money is all gone. If you buy a home, let's look at the 180 home, for instance, just through normal loan amortization, you will have amortized the loan down by $15,741, almost $16,000. That's equity for you. That's built equity in this home for you that you don't have when you're renting. And that's not including any kind of appreciation, property appreciation, or anything like that. Check out this final graph down here, the net worth over 10 years. So obviously when you're renting for the next 10 years, you're paying $1,200 a month. You're not building any equity and you don't have any equity. By the way, this graph says net worth. You could substitute the word equity there. So you don't have any net worth. You don't have any equity in any property if you're renting. However, after 10 years, let's for instance look at the 180. You buy a home for 180 after 10 years through your normal loan amortization and assuming a property appreciation rate average of 3% per year, which is probably low, by the way. If we look back to our county, our 62-year appreciation average is over 3%. That's, as far back as records go, 62 years. And the forecast, at least for the foreseeable future, is much higher than that. But let's just use 3%. The property appreciates an average of 3% per year, and you're paying your loan down at the normal amortized rate. After 10 years, you're going to have $100,000, $102,000 in equity that you don't have when you're renting. And of course, that gets magnified as you go up in purchase price because the property appreciates more. So you can see here, the higher purchase prices, you have even more equity after the 10-year period. So those numbers are pretty exciting. And again, home ownership may or may not be the right thing for you right now. It may not be the right decision for you to make right now, but I just wanted to give you this information. It's definitely compelling to look at these numbers, and it might be something that you would want to consider, if not now, maybe in the future. But of course, the sooner you buy, the sooner you start reaping the benefits of the property appreciation and the amortization. So if you'd like to take a look at your own situation and see what a home purchase might look like for you, feel free to reach out to me. I'll be glad to answer any questions or help you in any way I can. Thank you for watching, and we'll see you soon.